Imagine taking your company public for what, $4 billion?
Mm.
And then watching your flagship product literally just disintegrate on your customer's feed.
Yeah, not ideal.
Right. And then you sell off your entire brand name for pennies and basically wake up one morning to see your stock jump nearly 600%.
It's honestly unprecedented. I mean, we are looking at over 288 million shares trading hands today for a company that effectively sold its soul 2 weeks ago.
It's so wild. So welcome to the Deep Dive, everyone. Today is April 15, 2026, and we are looking at the absolutely absurd reality of ticker symbol BIRD.
That's BIRD, the ticker for Allbirds.
Exactly. And BIRD just closed at $16.99 today. That is an intraday surge of over 582%.
Up $14.50 on the day. Just massive.
Right. And this massive jump was driven by a pivot that honestly completely redefines the concept of corporate reinvention.
To say the least.
But before we get into the crazy mechanics of how this actually happened, a quick reminder up front. This deep dive is strictly for entertainment purposes only. The markets are incredibly volatile, the story is chaotic, and you should always seek professional advice before making any financial decisions.
Absolutely.
And hey, let us know in the comments if there are any other specific topics or, crazy market events you want us to explore next.
Because if there's one thing the market guarantees, it's that there will always be another wild story to unpack.
Always. Okay, so let's get into the breaking news that sent this stock soaring from under $3 to an intraday high over $23.
Yeah, let's do it.
So Allbirds announced a definitive agreement with an unnamed institutional investor. And this is for $50 million in financing, the stated purpose. They are completely abandoning footwear to pivot into AI infrastructure.
I still can't really believe it. And as part of this, the corporate shell is officially changing its name to NewBird AI.
NewBird AI.
Yeah. But what really stands out in their filing, and this marks a complete departure from their founding identity, is that they are shifting from an eco-conscious public benefit corporation to just a conventional corporation.
Oh.
They explicitly stated they will no longer prioritize environmental conservation.
So we're going from net zero carbon shoes to power-hungry server farms.
Basically.
And the proposed business model is to use that $50 million to buy graphics processing units, or GPUs, and they want to become a fully integrated GPU as a service and AI-native cloud solutions provider.
Which, brings us to the sheer logistical reality of what they are proposing here. I mean, transitioning into physical AI infrastructure isn't just about ordering some high-end computers online.
Right. It's a bit more complicated than that.
Just a bit. GPU as a service means you are renting out massive computational power to other companies so they can train their AI models. And to do that, you have to navigate this highly constrained hardware market where giants like Meta and Microsoft are already fighting tooth and nail over every single NVIDIA chip they can find.
And even if you manage to secure the chips, you have to put them somewhere.
Yeah.
You can't just stack a bunch of GPUs in an empty warehouse that used to hold bull sneakers.
Precisely. These server clusters generate an astonishing amount of heat, and they require massive amounts of electricity.
How massive are we talking?
Well, a standard data center rack might draw, say, 5 to 10 kilowatts of power, but a high-density AI rack, that can easily pull 40 to over 100 kilowatts.
Wow.
Yeah. You need direct-to-chip liquid cooling systems. You need to negotiate long-term massive power purchase agreements with utility companies, and that usually takes years of planning.
Which really puts that $50 million financing into perspective. I mean, $50 million sounds like a ton of money to the average person, but in the AI infrastructure space,
It's barely a drop in the bucket.
right.
As industry expert Bill Kleiman noted in the sources we looked at, building a real AI infrastructure business takes deep capital, specialized technical expertise, and incredibly disciplined execution.
Not just $50 million and a new name.
Exactly. $50 million might buy you a small cluster of GPUs, but it doesn't build the specialized facility to run them, cool them, or maintain them.
Yeah, and we saw another expert in the sources, Jim Piazza, highlight that this is a virtually impossible challenge for a management team that comes from completely outside the industry.
Right.
Which raises a massive red flag for me.
Yeah.
If the underlying business of selling shoes was already failing, we really have to ask, is this a genuine strategic pivot? Or is this just a desperate maneuver to use the magic letters AI to reset the narrative and pump the stock?
Honestly, it looks incredibly defensive. The AI space is experiencing, genuine, unprecedented demand right now.
Yeah.
But it's also wrapped in unprecedented hype. And the market reaction today, that 582% surge, It looks far more like retail excitement and speculative momentum tied to anything mentioning AI rather than like a serious validation of Newbird AI's actual ability to execute this plan.
Okay, so to really grasp why a company would abandon its entire global identity for a moonshot in server farms, we have to look backward.
We do. We need to examine the catastrophic compounding errors that completely destroyed their core product.
Because the failure wasn't just, one bad quarter.
No, it was a structural collapse of an entire business model.
So let's start at the origins, because the contrast is just jarring. The company was founded in 2015 by Tim Brown, who was a former New Zealand professional soccer player, and Joey Zwillinger, a renewable energy engineer.
Right.
And they launched a Kickstarter campaign looking for $30,000. And they ended up raising nearly $120,000 in just 5 days.
Which is huge. That kind of early crowdfunding success is a massive validation. It proves you've struck a nerve with consumers right out of the gate.
They definitely did. Their flagship product, the Wool Runner, quickly became the unofficial uniform of the tech industry.
Oh, yeah. You couldn't walk into a coffee shop in San Francisco, Austin, or New York without seeing a dozen pairs.
Exactly. They hit this perfect cultural intersection. The shoes were minimalist, they're machine washable, and they carried a really compelling environmental story.
They identified a genuine gap in the market. Before them, you essentially had dress shoes on one end or flashy athletic sneakers on the other.
Right.
And they created this whole new category of incredibly comfortable, understated, eco-friendly leisure footwear.
And it caught fire. I mean, Leonardo DiCaprio invested in them, calling them a model for the future of the industry.
Barack Obama wore them.
Yeah. And this immense cultural cachet ultimately drove them to an IPO in late 2021 that valued the company at a staggering $4.1 billion.
But we have to recognize that a massive portion of that $4.1 billion valuation was tied directly to their environmental ethos. They successfully marketed themselves not just as a shoe brand, but as a sustainability movement. And this entire philosophy really reached its absolute peak with what they called the M0.0 NS shot project.
The M0.0.NSA shot project.
The M0.0 NSA shot, spelled with zeros instead of O's, right?
Yeah, very clever branding.
They unveiled this at the Global Fashion Summit in Copenhagen. And the goal was incredibly ambitious, to create the world's first net zero carbon shoe, and to do it without relying on carbon offsets.
Which is a tremendous engineering challenge. And to achieve it, they used carbon-negative regenerative wool sourced from a specific farm in New Zealand.
Right.
But the real innovation was the sole.
Right, the sole. They used a specially crafted version of their Superlight foam. This was a carbon-negative bio-based midsole foam made with sugarcane.
Sugarcane, yeah.
And the manufacturing process here is fascinating. They use something called supercritical foaming.
Yeah, and to put that simply, instead of using harsh petroleum-based chemical blowing agents to make the foam expand and get fluffy.
Which is what everyone else does. Right. Instead of that, they inject a gas into the material under extreme heat and pressure. And when the pressure is released, millions of tiny uniform bubbles form.
Oh, that's cool.
It makes the material incredibly lightweight and bouncy, all while drastically reducing the environmental impact. I mean, they even used methane capture bioplastics for the logos on the shoe.
And perhaps the craziest part of the M0 NSHI project is that they open-sourced the exact recipe for this shoe.
They did.
They released a toolkit they called the recipe B0.0K to the entire footwear industry, basically challenging all their competitors to copy their sustainability efforts.
And as a piece of environmental leadership, it was remarkable. But as a business strategy, the tragedy is that the very materials that made them famous, these highly engineered, eco-friendly components, are exactly what brought the company down.
Which brings us to the operational collapse. Our sources point to a brilliant analysis by Gad Alon.
Yes, his scale framework.
Right. He outlines how weakness in one area of a business inevitably amplifies weakness in others. And the most glaring weakness for Allbirds was the durability flaw.
It is the ultimate irony. When you use natural bio-based polymers instead of synthetic rubber or traditional petroleum plastics, you are inherently dealing with materials that often lack strong, resilient cross-linking on a chemical level.
Okay, so what does that mean in plain English?
Without those tough chemical bonds, the materials just can't take a beating.
Ah. And customers across the internet started realizing this the hard way.
Very quickly.
They reported that the wool uppers would pill and thin out rapidly just from walking. And that innovative sugarcane sole we were just praising, testing showed it wore out 23% faster than conventional rubber outsoles.
That's a huge difference.
The friction of normal pavement would literally shred the bottom of the shoe, and the structural bond between the upper and the sole would frequently fail.
So you had customers realizing that their $100-plus shoes were becoming entirely unwearable in just 6 to 12 months of regular casual office wear.
And if your entire brand promise is built on saving the planet, but your product's short lifespan means a customer has to buy and throw away twice as many shoes, the math completely breaks down.
It totally does. You aren't saving the planet, and you're certainly exhausting your customer's wallet.
Exactly.
And when people realized this durability trade-off, the repeat purchase rates cratered, but instead of fixing that core issue and sticking to the casual leisure market they dominated, the leadership team overextended.
They tried to scale into performance running. They launched models like the Tree Dasher and the Tree Flyer.
Which was a massive miscalculation. The performance running segment is dominated by entrenched giants, Nike, Adidas, Brooks, New Balance.
The heavy hitters.
Right. These companies have decades of biomechanical research. They have testing labs and professional athlete endorsements. Allbirds tried to bring a nice sustainability story into a fiercely competitive arena where pure physical performance, impact absorption, and energy return are the absolute baseline requirements.
You cannot just slap eco-friendly foam on a shoe and expect it to hold up for a runner training for a marathon.
No.
It's a totally different physics problem. And as if failing in the running shoe market wasn't enough, they pushed into expensive apparel, trying to sell $250 puffer jackets and $88 dresses that nobody wanted.
Yeah, they ended up having to mark that inventory down almost immediately.
Ouch.
But the compounding error that really sealed their fate was their retail strategy. By the end of 2022, they had rapidly expanded to 58 physical, company-owned stores globally.
Wait, if your product durability is tanking and your repeat customers are vanishing, you are suddenly paying premium commercial rent just to sell fewer shoes to a shrinking audience.
That is the exact trap they fell into.
Yeah.
Physical retail for a direct-to-consumer brand introduces massive fixed costs.
Right.
You sign long-term leases, you pay for expensive store build-outs, you hire full-time staffing and maintain high levels of inventory in every location. And when foot traffic drops, whether due to durability issues, shifting fashion trends, or both, those fixed costs do not change.
So every dollar of revenue has to carry a much heavier burden.
Exactly. And the data shows this spectacularly. Their revenue per store plummeted 35% in a single year.
Wow.
They went from generating nearly $8 million per store down to about $5.1 million. So instead of generating new demand, these expensive physical stores were largely just cannibalizing the sales they would have made digitally anyway.
It's like an indie acoustic band trying to write a stadium EDM anthem. You completely alienate the loyal fan base that loved your quiet acoustic sound, and you fail spectacularly at winning over the mainstream festival crowd because you simply don't have the heavy bass drops they require.
That is a perfect analogy. You end up playing to empty rooms.
And playing to those empty rooms absolutely decimated their balance sheet.
Oh, it destroyed it.
Let's look at the financial reality of this collapse, because the numbers in the third quarter of 2025 are just staggering. Net revenue dropped 23.3% year over year to just $33 million.
Right.
Their net loss for that single quarter was $20.3 million.
And just to emphasize what that means, their net loss margin was over 61% for the quarter.
Jeez.
You are losing 61 cents for every dollar you manage to bring in. Over the 5 fiscal years ending in December 2024, they lost $419 million on $1.24 billion in total sales.
And the culprit here goes back to those fixed costs we just talked about. Their selling, general, and administrative expenses, their SG&A, were eating up roughly 70% of their revenue.
Meanwhile, their gross margins compressed down to around 42 or 43%.
It is basic, brutal math. If the overhead to run your business costs 70 cents of every dollar, but the profit left over after making the actual shoe is only 43 cents, you are bleeding cash on every single transaction.
There was no path to profitability. These losses weren't strategic investments in future growth. They were the steady hemorrhage of a business model that was fundamentally broken at scale.
Now, a company might try to argue that the broader macroeconomic environment was tough. Inflation, consumer spending slowing down.
It might try.
But the sources show that while Allbirds was shrinking, guiding down to just $161 to $166 million in total revenue for 2025, their direct competitors were absolutely thriving in the exact same economy.
This is the nail on the coffin for the macroeconomic excuse. Take Hoka, for example. When Allbirds launched, Hoka was a relatively niche trail running brand known for maximalist, chunky soles.
Right.
But they focused relentlessly on biomechanics and durability. Hoka compounded their growth at 36% annually, reaching $2.23 billion in fiscal 2025.
And on running, the Swiss brand, with the little cloud pods on the soles.
They compounded at 38%, reaching 2.32 billion Swiss francs in 2024 and maintaining gross margins near 60%.
So the footwear category wasn't collapsing at all. Consumers were still buying expensive shoes. They just stopped buying Allbirds.
Exactly. They shifted their money to brands that offered comfort, style, and crucially, products that actually survived a year of walking.
Which brings us to a detail that completely reframes everything we're looking at today with this whole AI pivot.
Ah, yes, the white flag.
Just over 2 weeks before this massive $50 million AI announcement, Allbirds agreed to sell its intellectual property and its assets to American Exchange Group for a mere $39 million.
An American Exchange Group is a mid-market wholesale distributor. They manage brands like Aerosols and Weight Mountain. Basically, they buy up distressed assets.
So let's do the math on that. Allbirds sold off its actual shoe brand, its name, its M0.0NSHOT tech, its designs, everything that made it a household name for $39 million.
Right.
That is literally less than 1 penny on the dollar compared to its $4 billion peak valuation just a few years ago.
It's a total capitulation, but it's also the key to understanding today's market frenzy. The entity that is pivoting to Newbird AI today is not a shoe company trying to buy computers.
No.
It is essentially an empty corporate shell. It's a publicly traded ticker symbol, BRD, that has been completely stripped of its footwear business, utilizing new funding to try and start an infrastructure company from scratch.
Knowing that, we have to look at where Wall Street currently stands on ticker BRVD. And, a lot of you have been asking in the comments for us to run a standard valuation on this, like looking at the PE ratio or doing a 10-year discounted cash flow analysis using, say, a 9% growth expectation and the 2.5% terminal growth rate with a 10% discount rate.
Right. And normally we would love to dive into a DCF and calculate intrinsic value for you. But as we always say, we strictly rely on the provided source data. And right now, doing a DCF or finding a meaningful PE ratio it's impossible.
Because the historical free cash flow base belongs to a retail operation that simply doesn't exist anymore.
Exactly. You are essentially trying to value a zero-revenue AI startup that just happens to inhabit a ticker symbol with a history of burning through hundreds of millions of dollars. You can't apply a 9% growth expectation to a business model that was just invented last week.
It makes no sense. So what are the analysts actually saying? According to the sources, current analyst sentiment is based on just one single analyst who has given the stock a firm hold.
And that analyst set a price target of $8.
Okay, an $8 target. But the stock closed today at $16.99. That is a massive premium to what the analyst thinks it's worth.
Huge premium.
Now, just to show how incredibly volatile and purely speculative this is, the stock plunged over 24% in after-hours trading, dropping rapidly down to $12.80.
The volatility makes perfect sense when you realize that the analyst rating itself is a complete artifact of the past. The entire thesis behind that $8 target is fundamentally obsolete.
Because the analyst was valuing a shoe company.
Precisely. If you look at the arguments driving that target, the bulls were arguing for improved profitability by 2025 based on cleaner shoe inventory management and the recent launch of a new product, the Wool Runner 2.
Right?
And the bears were pointing to continued revenue declines, subdued consumer demand for shoes, and high promotional discount activity.
Both sides of that financial debate were arguing over the margins of selling wool sneakers. But as of today, this ticker symbol legally doesn't even own the Wool Runner 2 anymore.
They abandoned footwear entirely. They sold it all to American Exchange Group.
You cannot apply historical shoe metrics to a shell company promising to buy GPUs.
You really can't. Though there is one minor bright spot for this newly emptied corporate shell. Our sources note that they recently secured a final dismissal with prejudice in a long-running shareholder fraud lawsuit.
Oh, right. What was that lawsuit about again?
It dated back to their IPO. Investors claim the company misled the market about the viability of its retail expansion and its product strategy.
Okay.
But the judge ultimately tossed the case out and denied the plaintiffs a chance to replead the case.
So if there's any good news for the people backing Newbird AI, it's that this specific legal baggage from the footwear days won't drag down the new venture.
True. But it certainly doesn't answer the question of how a $50 million shell company competes against hyperscalers in the AI space.
It doesn't. The 582% surge today wasn't driven by fundamentals or a solid business plan or like a competitive moat. It was driven entirely by the presence of the letters AI in a press release.
Yep. Pure hype.
So let's summarize this unprecedented journey because it is truly one for the history books. We've traced the path of Ticker Bird from its soaring heights as a $4 billion eco-friendly darling of Silicon Valley.
We saw how a genuine innovation in sustainable materials ultimately led to a catastrophic operational failure, defined by a critical lack of product durability.
We saw how leadership compounded that durability flaw with a disastrous overexpansion into expensive physical retail, creating a fixed-cost trap that bled the company dry, while competitors like Hoka and On Running easily captured the market.
And we watched them wave the white flag, selling off the very intellectual property that made them famous for a mere $39 million.
Pennies on the dollar. And finally, we arrived at today, where the empty corporate shell revives its ticker as a meme stock AI infrastructure play, sending the market into an absolute frenzy.
If we step back and look at the broader implications of this entire saga, it leaves us with a lingering question to ponder.
What?
Well, when a failed retail brand can boost its stock by nearly 600% in a single trading day simply by changing its name to include AI and promising to buy servers, are we witnessing the messy reality of a genuine technological revolution, or are we staring directly at the glaring peak of a massive speculative market bubble?
Oof. That is the perfect thought to leave you all with. It's an absurd reality, but honestly, we are all glued to the screen waiting to see how the market reacts tomorrow.
We really are.
Thank you for joining us on this deep dive into ticker BRD. Remember to stay curious, always think critically about the headlines, and we will catch you on the next one.
Until next time.